Welcome back to On the Tape. I am here with a returning guest who is an old friend of mine. I think he's one of the most brilliant minds in the business, clearly one of the most brilliant minds on CNBC. That would be Stephanie Link. She's the chief investment strategist and portfolio manager at Hightower. Stephanie, welcome back to On the Tape.
Thanks, Dan. It's great to be here.
All right, IRL. And listen, we sat down. We did a live event. You hosted, I think it was a Day of the Stars for Hightower.
Yes.
It was at the Yale Club. It was very fancy. I had to put a suit on. But that's
very dapper.
That is your clientele over there. That was a great event, actually. It was like you put together a bunch of strategists, market participants in your network, and it was, I think, a lot of Hightower advisors in the crowd there. And it was interesting because I did it also in 2022. It was the first week of March. And I remember I felt really lonely there. I was one of very few sort of cautious folks. Now, I am not a strategist. You are a strategist. You also manage, obviously, capital over there at Hightower. But I was definitely felt a little different in March of 2023 at the, I was not as lonely. So talk to me a little bit how you are thinking about running strategy at Hightower. You have lots of, RIAs and folks looking to you for guidance here. How's it feel right now, almost 4 months into this year? Because it really feels like a very different year than it was in 2022.
Oh my gosh, it's 100% different. It's harder this year than last year. I mean, I think last year we all knew the playbook. We knew Fed started to change and get more aggressive on rates and ending QE. But
people weren't buying it then. That was one thing. You know what I mean? Like early in the year, and it was kind of funny. And, when we think about what happened in March of 2023, we saw that some of the biggest regional banks in America weren't buying what the Fed was telling us about what they were going to do with rates.
That's for sure, right? And, well, I think because the Fed was so behind, and I think the credibility was a big issue, but everybody knew they should have been starting this whole tightening program a lot earlier, and they didn't. So it is what it is. It was what it was. Yeah. But last year we knew they were going to start to tighten. We didn't know how much, but we knew the cycle had changed, right? It totally changed. So we kind of knew if rates go higher and they continue to try to contain inflation, that long-dated, long-duration assets would struggle. What does that mean? Tech, growth.
NASDAQ topped out literally to the day that the Fed said that, November 2021.
Yeah, absolutely, right? So it was an easier playbook in that, well, I still lost money on the year, but I lost a heck of a lot less because it was more of a value versus growth, and all you had to do was be underweight tech, and it was scary, and it wasn't a fun year, but at least it wasn't as difficult. I knew what to do. The one thing I think people forgot is that equity markets are volatile, but they forgot that you could lose money in bonds as well.
Yes.
And so I think it was a double whammy. Sentiment was awful. Got it, right? So fast forward to this year, it's harder, right? Because we know all of the increases in the Fed funds from the Fed is going to slow everything down. And we know there's a lag impact. It's 8 to 12 month lag impact. And remember, last March is when they started talking about raising rates, but they were still buying bonds. So really, in effect, April it started. And so now fast forward a year, here we are, and we are starting to see things slow down. But it's really hard. It's really hard because there are some parts of the economy that are struggling. Manufacturing, we see the ISMs and the PMIs and all that. We see the new orders start to really take a nosedive. We also know housing has been weak. On the flip side, you have a consumer that has been so resilient, maybe not on the goods side, but on the services side. And we know services is 70% of the U.S. GDP, and we know that that's where the inflation lies. And it's very difficult for the Fed to get a handle on that. And so you have these cross currents that are happening. And I mean, I like to stay positive and look for opportunities. I do think there are opportunities in consumer, and I think as long as jobs stay okay, I know they're starting to head into the different direction, but jobs are still tight. You still have 1.67 jobs for every one unemployed person. So you still have a tight market. You still have wages going higher. I also would throw a wrinkle in. I think we can talk about this if you like, but there's really an opportunity in the China reopening. They're behind us in terms of pent-up demand. They just went maskless last month. So they are absolutely screaming to do things. And we heard from LVMH that they had sales up 30% in China. We heard Macau GGR, gross gaming revenues, up 55% year to date. So people are getting out and about. I don't want to own a Chinese company, but I do like to own U.S. multinationals that have exposure there. So I think there are like some pockets where you can be optimistic.
We'll definitely talk about that because I think that the precedent that was set by a lot of U.S. multinationals when Russia invaded Ukraine last year, it could really be a wrinkle in that whole reopening trade if there was any geopolitical dust up between China and Taiwan. And that rhetoric is clearly heating up. And again, I'm not hoping for that. I don't think anybody is really hoping for that. Let's take one step back here because it was kind of interesting. It felt like we spent most of 2021, arguing about the meaning of the word transitory and what the Fed, you know what I mean, what they thought it meant and what they were willing to do about inflation. And I think, going back to that issue about credibility, there's many people, Guy Adami, one of them, feels like they lost their credibility a long, long time ago. And, we often go back to 2018 when Fed Chair Powell came into the job and he made it very clear he wanted to normalize interest rates. He wanted to take us off that zero interest rate bound that we had been on really since the financial crisis or the global financial crisis, right? So they started raising interest rates slowly. I think the term they used was they were on autopilot. And then in late 2018, there was a bit of a growth scare and the stock market, the S&P 500 sold off nearly 20% in a straight line and they paused. And then we were off to the races again. So, we have the pandemic, 2021, you could have thrown a dart at any risk asset And again, we all thought that was Sillyville. And that's when we were debating about, whether inflation that we were seeing in the reopening trade here in the US and then in Europe was going to be a transitory sort of situation. I was definitely in the camp that, of course, we were going to see some sort of mean reversion, right? But the Fed kept on buying $120 billion worth of treasuries and mortgage-backed securities. And that was the thing that seemed absolutely insane, right? And so they finally do their, I don't know what you want to call it, and they just say uncle, and they stop, and then every long duration asset on the planet drops like a lug, right? And so I guess my point is like, here we are now. Fed funds futures are pricing in another hike when we get to this May meeting in a couple weeks or so. You saw James Gorman from Morgan Stanley, the CEO, saying maybe there's more than that, right? Because he actually seemed really interesting that he seemed more focused on them staying the course, battling inflation. There's a lot of strategists who think they've just gone too far already. Start looking under the hood at the data here. We're going to see unemployment tick up. The manufacturing stuff is going to be headed lower, and we could find ourselves in a worse than expected recession. So I know that's a lot here, but I really want to kind of key on, is the Fed likely to overdo it now the way that they were just kind of too complacent back in 2021?
I mean, it's a very good possibility. That's the whole problem of this year because we just don't know, right? We know we're going to slow. Do we slow into a soft landing? Do we have a hard landing? Do we have just a mild recession?
What do you think your base case is right now? And again, thinking about the fact that we have unemployment at 3.5% and we have some of those moderating factors as it relates to inflation, which is great. You know what I mean? It's great for consumers. It's great for companies, all that sort of thing. And listen, is there a scenario? Remember in January, it was like no landing and like YOLO. The stock market was up 20% in a half a second here. You know what I mean? Yeah. So like, I'm just curious, what are you thinking is the more likely scenario? You do look under the hood. You look at all the data sets.
In the camp of earnings recession.
Yeah. Which we are in, and that seems really clear. I think FactSet is noted on their Earnings Insight blog that we're expected Q1 earnings to be down 6.5% to 7% or so. Yeah.
So I think there's a chance that we are in an earnings recession. I'm not 100% convinced, and I'll tell you why in a second. But I think we're probably somewhere in between soft and mild recession. And that is because that's why I look at the consumer, and that's why we look at jobs, right? And that's why we look at wages. And I think when you look at ADP came out with a wage number most recently at 7% year-over-year growth. But if you switch a job, that number is 14%. So people are still making money. They can still find jobs. And as a result, and they're still frustrated from the 3 years of being, at home. So look, if you go to any restaurant, you go to any airport, you go on any train, you go to a movie, they're all packed. It's absolutely crazy what we're seeing. And so I think as long as the consumer hangs in, and I think they will, that's why I say if we do go into a recession, I think it's mild. I think there is a soft landing. One thing, Dan, you've been doing this just as long as I have. It's been wrong to ever bet on the consumer against them.
No doubt.
Even if they don't have money, they spend. Yeah. They increase their debt.
But since you and I have been doing this, we actually haven't seen interest rates like where they are right now as it relates to the consumer, and also the pace in which they have increased. And then if you're seeing consumer credit hit all-time highs, people have lost values in their homes, they've lost values in the stock market. If wage, this wage increases that we've seen, if they moderate a little bit or unemployment goes up to 4%, consumer spending is going to stop on a dime. It's going to stop on a dime, especially when you consider all of the savings that we had towards the end of the pandemic and how quickly that is eroding. To your point, it's like they're just YOLOing everything. And I'll just say this is purely anecdotal. When this stuff was going down with SVB, in our world here, I was on vacation that week.
Me too.
Okay? And you know what I
too.
also did when I got back? I canceled the vacation for this summer. And I'm just saying, and because you know what? I might still have PTSD from the financial crisis a little bit, but when you live in a city like New York and when you see so much of people's livelihoods, wrapped up in a lot of the stuff that you and I talk about every day, and we probably spend way, way more time than most Americans thinking about this sort of stuff, I get a little nervous about this stuff. And I worry about the people who think that their job is okay because they know that they've been getting spammed like crazy on LinkedIn for the last year and a half or whatever, and they think that they have this ability to go get a better paying job or something like that. That all stops on a dime. You know what I mean? And if we do see, some of the sort of, headwinds that I think that exist right now that are not being appreciated, at least by risk assets right now, specifically stocks.
So if we go into slowdown mode and soft landing / small recession, I think earnings can hold up better than people think. Yeah. And I think the reason is margins. Everybody is calling for margins to totally collapse. Well, the one thing about U.S. corporations, they don't allow them to collapse. Yeah. Not on purpose. They will cut costs. They have pricing power. They have for the last several years. And, oh, by the way, inflation has come down. Yeah, and supply chains have actually started to ease. So all of those things plus the dollar. The dollar's been weak. So U.S. multinationals, that's a huge tailwind for them. Do you know how many times I've heard, you've heard too, on conference calls and companies talking about, currency hit us by X amount. And I don't pay for currency on the way up or on the way down. But it is something that should tell you that the overall numbers, I think, could come in better than down 9%, down 10%, which is what some of the bears, down 20%, which is what some of the bears are saying. I think that earnings will hang in. And again, if you believe, like I do, that international is in better shape, led by China, led by not only Europe. Europe is actually better than what anybody thought, right? And that's because of the China relationship. We know that, and the warm weather. But guess what? Japan's also, the IMF has actually raised numbers as well. And it is quite interesting that Warren Buffett is buying over in Japan. So you have a couple of countries that may be able to partially offset what might happen here. And in the meantime, I think corporations are they're tightening up a bit because they do see that we are going to slow down. The big thing in my mind is inflation is coming down, but I think that's where the Fed has been so, they totally missed it. They totally missed it. Can they get it down to 2? No. Can they get it down to 4? Yes. But that actually wouldn't be such a bad thing either. Again, U.S. corporations, they're between the supply chains and inflation coming down. That's a huge difference than a year ago where we were.
Yeah, still 4 though with let's say a 5 Fed funds is not a great. You know what I mean? It's not a great setup. Listen, I am not an economist. I am not a strategist. I'm somebody who stares at a FactSet machine for 10 hours a day and then goes and talks about it on podcasts and on CNBC and the like. And last night on Fast Money, we were running through some of this. You've seen some of the sentiment data. There was a JP Morgan's survey. There was a Bank of America survey. Some of the headlines are like most bearish since 2009 and, all those sorts of things. And, my quick take, and I'd love to get your take on this. And Steven reminded me because he was watching the video this morning because he doesn't watch it live. He's 25 years old. You know what I mean? They don't watch TV. But he was saying, it was great how you started a comment saying, I don't mean to sound arrogant, but, and then so what I said was in my 25 years in the business, I've never, listen, I talk to a lot of folks as you do, investors, strategists, and I've never seen such a consensus on what people think is going to happen where like so many smart people that I know are going to be all wrong at the same time. I mean that really seriously, and so I'd be just really shocked about that because I think about, and I don't like to use this term, the smart money. I think it's being used less and less when we see a lot of the hedge fund performance over the last few years relative to the fees that they charge and everything like that. But, there's just a lot of people that that they just can't find good reasons to buy stocks right here. And you could say, well, that's the most bullish thing I've heard in a long time. But I want to run through the.
But I can tell you,
yeah.
I don't necessarily want to own the entire market. I don't want to buy an ETF in the S&P 500. But what I want to do is I want to have energy. I want to have some materials. I want to have onshoring themes. I want to have some technology. I don't want to be overweight technology, but some technology for certain, especially some of the names when you look back a year ago, they're still down, right? And I know everybody talks about AI and cloud and data center and cybersecurity, but they are real total addressable markets. They are real growth avenues for those companies. And so you try to pick your spots and you try to find valuations where you feel comfortable. But
it's hard to find in those themes right now. If you just think of like an NVIDIA, which has gained a lot of market cap on that. I'm just saying, so like one of the you could just put a finger on the direct recipient of this supposed beneficiary is trading 23 times sales, 62 times earnings this year.
I wouldn't touch it.
Yeah, right. And then even
I would touch Broadcom, which is trading at 14 times forward estimates, and they have AI exposure too. So there are Lam Research, we know the number is going to be crummy tonight because everyone's cutting wafer spend, but I think that at 14 times earnings, that too is also very attractive. I think there are pockets
But what about
within.
a Microsoft, $2 trillion market cap, trading 31 times this year? That's earnings, and 27 times next. Again, supposed to be a big beneficiary of OpenAI integration and all that.
Where I think actually they could have some upside is actually PCs bottoming. I don't think nobody's talking about that because we're not seeing it yet. But
we saw Apple down 40% PCs, and we
so
saw
that's
the
why
rest
I say,
of their
but if you're
competitors,
troughing this year, and that you might see some upside. I'm not justifying Microsoft, but I would also say the long-term average is at 35 times forward. It's at 27 times forward now. So it's down relative. Whether you want to pay that kind of multiple or not, I'm not going to go there.
So here's the funny thing, though. That multiple would make sense if we were in a interest rate environment with a 10-year, back at is like
zero.
Yes, or 1% to 2%. You know what I mean? Or in a Fed funds that was 2.5%. And I often go to this chart, go back to 1980, do it on a long scale. You can vision it, people in your minds here. Look at the 10-year yield, upper left, bottom right. It was high teens back then, and it went to zero. No one ever thought it was going to go to zero. You draw that trend line, at some point, the 10-year, and it's not trading particularly well, even in the face of what the Fed says they're going to do or what Fed funds are pricing. You have a 10-year trading at 3.5% or so. That's a pretty wide spread between what the Fed says they're going to do on the short end. You know what I mean? And
that's why we rallied in March, and the growth trade rallied, and tech rallied because everybody thought the Fed was going to pivot, and then we get all this data. And they're not pivoting.
But the Fed was going to pivot for the worst reasons because we had banks going under, and we're going to get
like. But they raised rates in the face of that. So to me, to the point of pivot, they didn't just do this for the last year to all of a sudden say, okay, we claim victory and then now we're going to go reverse course. No, they're going to keep it for a long time at 5.25 and watch the data. And that's the most important. And inflation is not going to come down to the 2% target. So that's why the rates are going to stay high, which is why you don't necessarily want to have a whole basket of growth stocks or technology stocks. That's why I think energy will work and industrials will work. But I also think consumer discretionary will work because what we talked about before.
Well, interesting. So you were last on September 30th. It was the last day of Q3, and you had a couple interesting comments. You said consumer discretionary should work. It's been an outperformer this year. You also really liked energy, which I think is interesting. As far as tech, you thought very similar to what you just said here. You want to kind of pick your spots a little bit, but you seemed pretty constructive, and that was like kind of the right way to be. The stock market at the time, I think, or a couple weeks after that, made a low, and it was kind of a panic low if you look at that October low or whatever. So, the S&P's up about 20% since there. The NASDAQ, up a little more than 20%. So it's interesting when you think about how concentrated both the S&P and the NASDAQ are with some of those big names. You've seen it, increasing breadth, right? And so energy's been a big part of that. And there's other areas that were kind of hard hit, earlier in 2022 that started to participate. So let's just take a step back to this. You want to be exposed to onshoring trends, okay? And so it's interesting when you think about some U.S. multinationals. You just said this. You want the exposure that they have to China, right? I look at this and I see some of the headlines about, Apple obviously diversifying away into India is a big thing. Tim Cook was just over there. They introduced some of their new stores. They're manufacturing there. I just wonder, what sort of juice a lot of U.S. multinationals are going to get from China here on out a little bit, especially as the Chinese, we are clearly living in a bipolar world right now, right? And
Yes.
it doesn't get better from here. And the fact that, Macron, so obviously the Prime Minister of France is getting really cozy with President Xi, that makes me really nervous. And for people like Tim Cook, who've cozied up to the Chinese for a very long time, and Elon Musk has spent a lot of time over there. It's interesting that he was not at the Shanghai Auto Show. And so I just wonder how much commitment the Chinese are going to have to U.S. companies if we continually get it dialed up on the geopolitical front, and then the Europeans try to draw or drive some sort of wedge in between us. China might not be the market going forward that a lot of U.S. multinationals were hoping it would be for growth in the next decade.
It's not going to be boom and bust. They're just not going to do it. If they grow 5% this year, that's a victory for them. But that's also a victory for global growth because it's been growing at sub 2% for the last several years, right? So I think what's important is this might not be a secular growth idea. It could be cyclical. It could be, okay, we were just closed for 3.5 years. We're pissed off. We want to get out and about. We want to do our thing. So here's an interesting stat. The Chinese consumer accounts for 17% of global luxury sales. Pre-pandemic, it was 30. So just to get from 17 to 30, which I'm very convinced that we will, or even or something close, that's huge.
What if it's not U.S. brands? What if it's LVMH? What if it's European brands? So again, think about how.
Well, LVMH owns Sephora. They're not going to own Estee Lauder. I mean, no, they will own what they want to own.
What about products like iPhones and so again, Apple is not the top 3 smartphone in market share. Tesla's not top 3 in EV market share in China. So when you think about the big contributors to S&P earnings, you know what I mean? Those are really important names. NVIDIA can't sell advanced chips in China, right? The list goes on and on. I just, I look at the writing on the wall here, and I don't see it getting better, so, a lot of people.
I would argue that, so they just posted a pretty good GDP number, 4.5%. Last was 2.3. Retail sales grew 10.9%. 10.9% compares to the prior quarter of 2.4. So that's huge. So maybe they aren't only going to be buying U.S. companies, but they're going to be buying a whole bunch of companies. And if I can find, I don't necessarily have to own U.S. companies that have exposure there. I can find European companies, to your point on LVMH. I don't think that's going to be the case. I think they're going to buy everything. They're going to want to go everywhere. They want to go to Starbucks. They're just beginning to drink coffee, right, in that country. So, and Starbucks is the best, and there's limited competition. And what about Nike? Of course. They have the best products out there.
Mm-hmm. Is that what you run? You run on Nikes?
I actually don't.
What, really?
Hoka.
Really?
Yeah, because I'm an old lady.
Oh my God! Do you wear those around too? I look at these Hokas and I see these
ugly.
people, and they look like space shoes.
They do,
or something.
but they're so.
Who
good.
owns Hoka? What is it?
I think it's Dick's.
Really?
Yeah.
Okay. I see a lot of them. Dick's Sporting Good owns.
No. Deckers. Deckers. Excuse me. I'm sorry.
Okay,
Deckers owns them.
Okay.
Yes. And they're ugly, but they work. They really, really do. And I'm a runner. I've been for 30 years, so I have bad feet. And this is the only one. I used to have Nike though, all the time. Now
I use their Zooms. I like their Zooms. But I don't
Zooms?
run like you do. I run like an old man. I run 3 miles on a treadmill.
That's not an old man.
Yeah.
We're getting older, Dan.
I trust me. I feel it. Let's talk about earnings season right now, the here and now. Okay, so I just said the Nasdaq's up about 20% on the year. The S&P is up 8.5% here. Let's just call it we're in an earnings recession. That's something that I think anybody could have seen coming a little bit. But you just mentioned there's some tailwinds. When you think about the dollar round tripping this entire move, and we look at how much of S&P earnings and sales come from outside the U.S. That's great. And it's funny, the currency thing is kind of funky because when the dollar index was trading at 114 last year, all we heard on every call was constant currency, constant currency.
So true.
Right? So you just said it. You don't pay for it when it helps, and you're not going to overly hurt them when it doesn't, one way or another. So what's your take right now? We've gotten the banks out of the way. Do you want to give us a bit of a rundown? I know you look at this sector very closely. I know you were optimistic on valuation leading into, especially the money centers in particular. We just had a great conversation with Danny Moses, Porter, and Vinny, his two partners that were all in The Big Short. And those guys, I think like you, see opportunities, but they also see stuff in the regionals that they don't particularly like. I'm just curious, like, what did you glean, at least from what we've seen so far? I know we haven't gotten too much in the regionals. Do you feel a bit more optimistic as even just buying on valuation right now?
Yeah, no, on the financials for sure. So I think that the regionals, I wouldn't touch one, not one. Not especially since you can get Charles Schwab down 34% year to date, and that's not a.
Do you worry? So Schwab, when it reported on Monday, it was trading down. I think it traded as low as 48 or so, and I think the low in March was like 45. Is that panic day or whatever? And again, I think it was above 80 just like 2 months ago or something like that. Do you worry that it reversed? It's trading, I don't know, 55, 56 or something, up from 48 in 3 days in a straight line. Do you worry that they're getting ready to do a capital raise? Is that something?
No,
you don't.
They have access to $300 billion from the government programs alone. They could sell their CD book and raise $10 billion overnight. So no, there's plenty of places that they don't need it right now.
Okay. So you bought it in the hole and you're sticking with
March,
it, and this is a long-term hold.
I bought it in March into when I was on vacation, when everything hit the fan, because I just said this is the top 10 U.S. national bank in the country. They are adequately capitalized. They have access to all kinds of programs, albeit expensive, right? But they just posted 6 to 7% organic growth and NNA growth in the face of 30% declines in deposits. So to me, that was an opportunity. I wouldn't touch any of the regionals because I think they're going to continue to lose share. You asked me if I was more optimistic. Yes, because the big guys, only on the big guys, because they're the ones that are taking the share. I think JP Morgan is still too expensive. It always has been, for good reason. I understand, but I think you can make more money in something like a Wells Fargo, which has so many problems. Charlie Scharf is just ticking off one by one to fix. And you think
he's doing a good job?
I do, and you know me. I like a restructuring story, or I like a story that's messy that gets less messy, right? So I think,
and that's been messy for a long time.
A long time, but it was up 63% last year, and everybody hated it.
All
did.
Peers, yeah.
So I thought Morgan Stanley did a fine job. I think he's doing a great job in terms of diversifying. So I think you could pick your spots within financials. I am overweight financials. Those are the names that I own. But, you pick and choose. We'll see what American Express has to say tomorrow. I think that'll be kind of interesting, especially in light of some of the news on the fringes from like Discover and Capital One. Those are
corporate
messy.
Travel is kind of interesting. Some of the things that the airlines said, I think American and Delta last week, United, the stock's trading very well today. This is Wednesday into the close after they reported, we all know it. Like you started out by saying, you go on every plane, they're jam-packed or whatever.
Well, it's also business travel. Yeah, business travel is starting to recover too, and they're big on that front.
Yeah, but totally anecdotally, it feels like everybody that I know, we all used to travel multiple times a month. People are traveling so much less.
Yeah.
I mean, for the reasons that we used to travel for, like the idea of going and speaking someplace for like an hour and then turning around, coming, that's gone. Meetings, like, so I feel like that structurally is going to be a bit impaired.
I think so, but it'll be better than what it has been, right? Because it came to a standstill during the pandemic. So I think it's gradually getting a little bit better. We'll see. You know what? If we do have a recession, we know it's going to slow. So we got it. So you just gotta keep an eye on it. American Express is rarely does it trade at the multiples that it's trading at right now. So it's not getting credit for not a lot. I don't own it, but I have in the past, and it's a quality. I mean, this is the kind of time when you can buy some really great quality number one, number two players in each industry.
And what are your time when you say that? What's your time horizon on that generally?
Well, I mean, I have a long-term time horizon, but is it a year? I mean, we're all mark to market every day, and we're all mark to market every year. Right. So
yeah, but you don't make decisions saying that if I got a 20% move in a few months, I would take the gain. Would you do?
Sometimes I'll tell you what, I gained 20% in Target when I bought it at the end of last year, and our friend Scott Wapner was giving me a hard time. He said, "Wait a minute, you said you liked it," and I said, "Yeah, but I gained 20%."
Guy has a memory like an elephant, Scott Wapner, right?
He?
I mean, come on.
But I will tell you, Mr. Kramer, when I worked with him, he said never apologize for taking a profit. Yeah. And so that's why I trim along the way. But I mean, if I'm going to buy something, I have to feel like in 1, 2, 3, 4 years, it's got secular growth and it has the right business mix and right margin upside and free cash flow gen and all that. So,
are you more inclined to take profits on stocks that you own? Because of good or bad news. Do you understand what I'm saying? I'm a trader. I always think about if I'm buying something, I keep moving up a mental stop in my head. You know what I mean? And so oftentimes, and to your point, I think you just said this, no one ever went broke taking a profit either, right? And so that's kind of the mentality that I grew up in. Sometimes people wait for a story to go bad before they start selling versus like, hey, listen, this is great. You know what I mean? I didn't expect this sort of move in this short period of time. I'm going to take a profit here. I'm just curious, how do you think about that?
Well, what I think about in my portfolio that I run is I'm a very concentrated portfolio. I only have 30 names in the portfolio, right? So they're very large. And I kind of try to keep each position size relative to my bench, 300, 400 basis points overweight, right? So something like a Meta, which killed me last year, but is up 80% this year, it went from a 4% position to 7.5%. That's way too big. You can't. That's just way too much risk.
Did you average down last year?
Yes, I did.
You did.
I mean,
and what are your rules about that? Because that at the lows, it was down 77% from its all-time high.
Oh, I know.
Oh, sorry. I didn't mean to remind you.
I know. And you know what? Every day on TV, they would remind me and everybody else. And so here's what my thought on Meta at the time was I did not think the company was broken. I think that they have a huge, huge installed base, 2 to 3 billion in MAUs and DAUs in the flagship Facebook. Reels was just beginning. Stories they got wrong initially, and it took them 6 months to fix. Reels they got not wrong, but just it was small and they weren't building it out, and it took about 6 months to fix. That's now a $6 billion revenue run rate. And if you look at click to message, that actually now is a $10 billion revenue run rate. I was looking at all of these things and saying these all have such potential. Zuckerberg has a great team, and oh, by the way, they're as fat as hell, so they can cut costs. And so here's an interesting stat for you. So you know how they've announced layoffs of about 17,000 since November, right? Before November and the cut and the layoffs, they had for the prior four quarters, they hired 90,000 people. Think about that. Think about how fat and they got, and all the FANGs did it, and that's why you're seeing it all on Unravel right now. But there's more he can even do. So I kind of always thought, well, in the back of my mind, if he ever gets religion and he starts cutting costs, there's a lot they can do there. And then if they ever can continue to try to build out these other growth avenues, then I think they could do well. And advertising, we know it's cyclical; it's going to come back. So to me, it got to the point where it was at like 11 times earnings, and it was at 7 times EBITDA. Yeah. I mean, this is a company that made money, and so to me, I just thought it got way, way, way overdone. It was probably way over-owned, and that's why it kind of tumbled. But now I hear it, fast forward, up 80% year to date. So I've been trimming.
So let me ask you, so you trimmed that up 80%, and that's great. I mean, you obviously in the throes of, kind of the panic, you kind of average down, and I'm sure you got a bunch of those losses back.
Yeah.
Do you ever think about, Snap, it's a $17 billion enterprise value. They play in a lot of the same places. Facebook's been ripping off their best stuff for years. And I'm just curious, do you ever think about, so here's my $500 billion, kind of play here, but some of the similar themes, there's a broken stock. They've been cutting a lot of people. They've been, getting down to their focus. Do you ever extrapolate that and look at other stories that are in and around it?
I mean, I follow them, but it's not something that I want. I don't want to own the number 2 or number 3 player. I want to own the number 1.
And that's in every industry for the most part. You feel that way?
Pretty much. Yeah. I've learned. Not the hard way, but I've just learned over time. If you can get the number 1 player that's getting crushed, that's the way to go. If you believe that the story and the thesis still makes sense. Sometimes the story changes.
Did you buy Netflix last year?
I did not.
You did.
It never got cheap enough for me, and I actually do not like streaming at all. I think it's way too competitive. They are now going against what a growth company would want you to think about, subscriber growth. Now they went to they're no longer talking about subscriber growth. Now they're talking about let's be profitable and let's generate free cash flow. And it trades at 28 times. and numbers are not going higher, and you got Disney, just breathing down their neck, but you also have all of these other companies. It's just too competitive.
All right, what about a PayPal that was also down like 75% at its lows? This is trading at a pretty reasonable, valuation, expected earnings and revenue growth, double digits, and a high gross margin company, and like all this. I'm just curious, like, is that a name? Like, did that pique your interest at all?
Absolutely.
Yeah,
it definitely did. And
it doesn't trade well this year. No. So it's interesting when you look around. So it's up like 5% on the year.
I know.
It's up obviously considerably from its lows, but it's still down a whole heck of a lot. Square does not trade particularly well. So there's some stuff in fintech that like it doesn't feel like it's bottomed just yet.
I think that there's a lot more competition in fintech than people talk about. And I'm going to tell you, like, just from the traditional bank companies, right? I mean, Bank of America spent $10 billion over the last decade just on technology. So, it's on the margin. It's not the same as PayPal. I get it. But at the same time, there is competition. I think with PayPal, I'm more intrigued that the CEO is retiring, right? I think it's this month. I think it's the end of this month. Yeah. That's probably a positive. I hate to say that. I don't want to be mean or disrespectful. He's done a great job in terms of building out the company, but I think the last couple of years, execution has not been the best. I am very interested that you have activists in that name too. It falls into the growth camp, and I don't want to own a lot of growth.
So let me ask you this. Here's one, Google. And again, like it's interesting that you mentioned activists, and I was wondering this. I know a lot of these share classes, it doesn't matter if you get involved, but this kind of the whole idea of public opinion, and especially in some of these really big names, a lot of people have been calling for Sundar Pichai, to be out, which I think is really interesting when you think about this company. They have 6 or 7 properties with 1 billion monthly active users. They have had this dominant share in search and digital ad, that sort of thing. And obviously, Microsoft. I think this Microsoft Bing and the OpenAI, I think it's going to be just an absolute sideshow. I just don't think Bing is ever going to take meaningful share there. I think that obviously in their productivity tools and stuff, if they're able to kind of really harness this technology and do it better across their suite of, like product, I think that could be huge for them. But again, they're still competing with Google on that too. So I look at Google and a lot of people will just say, well, the valuation and this, but I say to myself, okay, that makes me a bit nervous here, especially if they were to mis-execute right now. And even if they were to lose a little share, I'm just curious, what is your thought there? And might we see some activists, and again, they don't have to actually Google board and Sundar, they could just push them aside. It doesn't matter. But once that gets out there in the kind of like the public opinion, it could actually influence investors a little bit.
Yeah, no, look, I don't own it. I am not a fan of the C-suite. Yeah. I won't name any names. I think there's a lot more they should be doing on cost cuts and expense management. I think there's a lot more they can do in terms of transparency. I think they're the worst of the FANG on transparency. And yes, they do have a great franchise, and franchise is. But it won't take much. Now, look, I'm not a big Bing believer either. But even if Bing went from 0 to 5, that's like 10% hit to operating profit to an Alphabet. So to me, there's more risk. And I think digital advertising, while I think it's going to come back, I think it is going to take a while. And if you're thinking that travel starts to really fall, that's 10% of their search. So to me, I just feel like there's still a better value, believe it or not, in Meta. It trades at a little less multiple. It's not as cheap as it once was, Meta, but
they're going to need to come up. Meta's going to need to come up with something, and it clearly wasn't the metaverse. You know what I mean? Because we are literally. If you think about the entirety of Meta right now, it is all on your app. It's all on your iPhone. It is literally Instagram and it is Reels, and that's it right now. So, quick one though. On the Google or the Alphabet, I mean, in 2015, this was a company that nearly had 80% gross margins, and this year they're expected to be 60%. So when you think about like on the margin, if they were to start to lose some of that share, I mean, once this thing has a 5 handle on it, it's a different story. All right, we get a lot of criticism because we're always focused on a lot of the big names. What are some like under the radar things that like maybe when you're going to sit down for the halftime report, you're like, should I talk about this name? Because do the people really want it? Our listeners really want to hear some stories that we're just not talking about all day on CNBC and thinking about, you know what I mean, that are like A1 in the Wall Street Journal.
Yeah, I like Ingersoll Rand,
okay,
which is not unknown or undiscovered, but I don't think people talk about it. I don't think it gets a lot of attention. It's all on this onshoring.
And just give me in a nutshell what the onshoring thesis for Ingersoll Rand. What is it?
Well, the onshoring in general, right, as the kind of like build the country better, whatever you want to call that. We have $1 trillion in bills that got passed that are going to help our infrastructure. Whether it gets there or not, that's another question. I'm in the mindset that it has to. You have the whole semiconductor, the CHIP Act. It takes.
So you like Broadcom, you mentioned.
Yes. But for Ingersoll Rand, you need materials to build this stuff, right? I recently bought back Freeport-McMoRan because you need copper to build things, right? So this is a great company with dominant share. They have a huge backlog, double-digit backlog, margin upside of about 200 basis points. And again, it is kind of the onshoring theme as we build these plants and we build bridges and we help on the roads and everything else.
So this is a longer term thing because you're not like some of these stocks have probably benefited a little bit from the passing of these bills over the last 6 months or whatever, but they're not likely to see orders right away from that sort of thing. So it's like thematic, and you want to buy them at good valuations.
Yeah,
it sounds like.
And I do. And again, kind of a little bit off the radar. Okay, so another one that's not probably on the radar, but it's been a hell of a stock year to date is GE Healthcare. Yeah. So GE, I own GE too, which has also been a good stock.
What's going on in GE?
So they spun off GE Healthcare. They're going to spin off the renewables business, which is terrible, in January of next year. And you know just as well as I, when a company spins off, not only do the spins do well, but the parent company does well because guess what? Everybody was too disorganized. They were everything. You couldn't appreciate anything because no one could put a ton of attention into anything, right? It was conglomerates, they don't work. Period.
This is the first reverse split in my memory that has actually worked really well. Is that fair? Usually they go back to where the stock was trading before the split.
When this is true. Yeah. When Larry Culp joined the company a couple of years ago, he was at Danaher. Just go look at a chart on Danaher over the years.
DHR, is that the ticker?
Yeah. It's a phenomenal company. He ran it exceptionally well. He retired and then he went on the board of GE, and then we had all these problems with management and at GE, and they decided to hire him, and he has done nothing but execute on the plan. He's he's going to spin off all three. They have the world-class aviation business, right? They make the engines for Boeing and Airbus. And it's like they are the best. They are the number one player, and they do it really, really well. It's always been the gem of the company, but it never got appreciated because you had problems in healthcare and you had problems in renewables and all that sort of thing. So they spin it out. They spun it off GE Healthcare. So I like the GE piece because I like that it's going to eventually be a pure play on aviation, and I like management. And that's going to help. By the way, free cash flow is going to continue to improve as the whole Boeing thing gets better, and as I think you're going to continue to see growth in aviation. I mean, you have a duopoly. You've got 4,000 to 5,000 planes in the backlog at each company. So they are the ones that are providing. So anyhow, that's GE. GE Healthcare, it's been around for 125 years. And they have an exceptional client base. They also have focused on recurring revenue and digital within their business. And this is think about imaging. When you go to the hospital, you think of most of the equipment you see in a hospital is GE Health. Anyhow, their margins were at 17%. Siemens, which is a competitor, margins are at 23%. If Siemens could get 23%, GE Healthcare, which is a better product, better clientele, and also they had some supply chain issues in China. As that get resolved, I think that could catch up, and I love a margin expansion story. So I like that one very much. So just a couple of
No, that's great. I mean, again, we're trying to give the people what they want. They want less of us and more constructive people on the stock market right now. So Stephanie Link from Hightower, we really appreciate you being here, laying out what I think was a very constructive view of not only the U.S. economy, how things don't have to go pear-shaped, and how the stock market continue to work here in that environment, and a couple of really great ideas, or a handful of really great ideas. So thanks a lot for being here.
Thanks for having me. It's great to be here.